Good morning and welcome to this new webinar hosted by Alquity. Today, Michael will deliver a 15-minute update on the Indian market, highlighting recent developments, including the key impact of the budget and the RBI latest decision. Following this update, we will open to a Q&A session. Let's get started. Mike, the floor is yours.
Thank you, Mark. Good morning, good afternoon, everybody. On the next slide, just for those of you who I haven't met previously, just to give you some background, I'm the Indian fund manager here at Alquity. I've been investing in that market for almost 30 years now. I'm also the head of global emerging markets. Kieran and Dan are the other two members of our Indian team, and we've worked together now for around 6 years. We have a wider number of people supporting us. I'd like to highlight Vikas, who is our on-the-ground research analyst as well. So we have a pretty broad and a very experienced team looking at India. And it's one of the most exciting markets that we see in emerging at the moment. So let's now move straight on to the budget, which happened at the start of the month on the next slide. This was really powerful for the market because it increased tax-free income allowance. That means a number of people, well over 10 million people, will move out of the income tax net entirely. And the tax bands were increased within that. So everyone will have less tax to pay, and that will provide a really strong boost to consumption. And that was not expected. In addition, infrastructure investment is ongoing. It won't be an exponential growth, but it will grow in line with nominal GDP, so over 10% growth in infrastructure. And both these things are combined with strong fiscal discipline. The budget deficit for the year that ends in March is going to be about 4.8%, which is a bit better than expected. And we expect, and the government expects, that to shrink further in next year. Now, on the right-hand side, we focus at Alquity on long-term domestic structural themes. And so the consumer discretionary is a very large part of our portfolio and always has been. So it's over 30%. That's much, much higher than the ETF or an average of 5 of our closest peers. We are uniquely well positioned to benefit from this stronger consumption as a result of the budget. And that's hugely important for performance going forward. On to the next slide. And we've been talking that interest rate cuts are imminent, and they are now here. The blue line is the Reserve Bank of India interest rates. The orange line is consumer price inflation, and the red line is core inflation. And you can see now that, again, earlier this month, we had the first interest rate cut from the RBI of 25 basis points. Since we put this chart together, we've seen a further decline in inflation from 5.3 to 4.2%. So again, that gives the RBI more room to cut rates in the future as well. And that's really positive for positions in the property sector and certain financials. So that's the second bit of good news that we've had during February. The next bit is about the rural recovery on the next slide. And again, we've been talking for almost a year and positioned ourselves for this rural recovery, and it's now here. Around 17% of our fund is sensitive to rural growth. And it's important because a third of total consumer goods sales go to the rural areas. That's a big number. First couple of comments from Nielsen, that rural markets are leading the charge, outpacing urban consumption. That's what they said about the quarter ending in December, where sales volume jumped almost 10% in rural areas, up from 5.7%, so an acceleration, and double the increase in urban areas. And then finally, a comment from Maruti, which is India's largest car manufacturer. The rural growth last quarter was 15%, urban was about 2.5%. So a couple of points there. Firstly, clearly, there's acceleration in the rural economy. There's no slowdown there, which is certainly where the market is talking about a narrative which is false. And secondly, urban is lagging a little bit. But the previous two slides, we talked about interest rate cuts, a boost to consumption from income tax cuts. These are very catering to the urban part of the population. So rural's doing well. Urban's been a bit weaker, but the measures that have been put in place are going to accelerate growth there. And now the next slide is one that we added unexpectedly because the BJP did incredibly well in the last state election in Delhi, winning it for the first time in 26 years. That's a huge indictment of Modi's popularity still. The Congress, who are the only credible national opposition, won 0 of the 70 states in that state assembly. There is no credible opposition. And this is now the third election victory that BJP has won post the national elections back last year, where they won that, but with a reduced majority. So this very much puts to rest the idea that Modi's popularity is waning. It absolutely isn't, as we can see from these election results. So then moving on to the next slide, this tackles two things. Firstly, the question about valuations in India, which always comes up. And secondly, why, given the good news we've had, why is the market having a little bit of a correction? So let's start with the long term first. You can see there that India's PE is 24 times. That's a big number and more expensive than pretty much any other market. Now, firstly, that's not new. That's been the case for many, many years, and we know that is no bar to strong performance. Secondly, it's high for two reasons. One is growth. Now, we've put in 17% earnings growth there. Actually, a lot more than that has happened on average over the last 5 years. But factoring in the growth, the price to growth ratio is 1.2 for India. That makes it cheaper than the US, Japan, etc. More expensive than Korea or China, but they're deeply cyclical markets with bad governance. So the growth is what you're paying for. The second thing is in the middle, the return on equity. India's return on equity has consistently been one of the highest in emerging markets, and it's second only to the US. So that high PE is justified because you have the return on equity and the growth. And this is linked to the last bit, which is why we've seen a correction in Indian valuations over the last few weeks and months. People are concerned that following the GDP number of 5.4%, the growth story in India is coming to an end. You absolutely don't pay this kind of valuations if you have minimal growth. And as I said, that's what supports it, along with return on equity. Now, we think this is an absolutely false narrative. The reason the GDP was weak in that quarter was due to floods and heat waves, more than normal, the disruption from the election, and also from the skewed festival season, which is very back-end loaded. All the subsequent data, including corporate earnings, shows that we've seen an acceleration from that 5.4% through December and into January. And when we see the next GDP print, that will certainly be a much better number than what we've had previously. So our view is that growth in India is a blip. It's absolutely not broken. Therefore, the long-term investor, valuations are actually an attractive point to consider getting into the market. So that hopefully addresses many of the questions that I know I'll be asked at the end. So moving now into a bit more of a deep dive of India and onto the next slide, where we look at the first example, which is our flywheel. This breaks down the portfolio into themes and subsectors. And our fund provides a concentrated focus on the dynamism and, critically, the domestic growth within India. So financing India, building India, organized retail, travel. These are the areas that will drive India's growth and, critically, are not linked to whatever else may be going on in the world with China or Trump or whatever. My job is to provide the best of India, and we have a multi-cap approach. There are some large companies that are excellent, where we see strong earnings growth, and you can see that on the right-hand side of the chart on the right bit of the page. But there are a number who are smaller cap, who are uniquely positioned for these opportunities. And an index tells you what has done well, not what will do well. And we build our portfolio to focus on these structural themes, whether they're large or small cap, or whether they're in or out of the index or ETF. 20 of our 42 names are not in the index. You can't get that exposure from the ETF. And 39 of our 42 names are domestically driven. That's critical for India's story. It's a domestic story. And as I said, that's perhaps even more important given we now have a Trump presidency. So we've always been like this, but given Trump's comments on tariffs and so on, India is relatively immune to this. Exports to the USA represent just 2.7% of GDP. For Vietnam or for Mexico, it's 10 times that. And India's growth is driven by demographics, by the shift to the organized sector. It's not, in contrast to China, driven by exports. So now let's continue with this theme on the next slide. Many of you, if not all of you, will have seen this slide many times in the past. I make no apology for this. It's a reminder of why India deserves a standalone allocation. Demographics. The purple line is India's population. The red line is China. India has already exceeded China's population and won't peak for some decades. India has the world's largest, youngest population. And young people consume more. On the right-hand side, we show the shifting consumer mix in the population. In 2021, 77 million households were in the consuming class, high and upper middle income. That's projected to move to 175 million households by 2030. That's 100 million households, about 400 million people. This is the story of India that underpins the growth and underpins our portfolio. So now let's delve into this a little bit more. I mentioned before that we have a large number of positions that are not in the index or the ETF. And there is the tyranny of benchmarks these days. We focus, however, on long-term structural themes. That's what delivers the performance. So take leisure. The chart on the left shows the number of airports in India with over 3.5 million passengers per year. In 2020, there's a handful. By 2033, there's going to be a lot more. And India is going to become the third biggest domestic travel market in 2027. That's a structural, domestically driven growth story. Well, how do you play that? Well, in the ETF, there are 3 leisure names. Indigo, which is an airline, Indian Hotels, and the Railway Catering Company. The exposure in total is 1.5%. For a really powerful theme, that's not a lot of exposure that you would get through the ETF or indeed our peers. In our portfolio, we have a much higher weighting, as you can see. Lemon Tree, which is the Premier Inn or the Mercure of India, trading on half the valuations of Indian hotels. Sami Hotels, even cheaper. And then Ixigo and Make My Trip are online travel agencies. And that is a much better way to play the growth in leisure, in our view, versus an airline, which obviously is subject to the vagaries of oil prices and so on. So we focus on this theme. You have more weighting to it in our portfolio, and we have what we would consider to be better and less risky with better valuations in terms of the names as well. That's how we think about things. And so on the next slide, let's delve into Ixigo a little bit more. It's out of index. Market cap is about $650 million. It listed in June. It's the leading online travel agency for the next billion users. Make My Trip, which is NASDAQ listed company, focuses on the upper middle class, the big cities. Ixigo focuses still on that domestic travel market, has a greater focus on trains and buses and on smaller cities. Hence why it's the platform of choice for the next billion users. They have 480 million annual active users. That's a huge number for a small company that no one's ever heard of. That is the beauty of India. And they have differentiated features versus the competitors such as price lock, refund policy, etc. And we rate it a C in our bespoke ESG policy. That's the kind of company we like. So moving on to the retail theme on the next slide. Two examples here. Aditya Vision, which is an electronics retailer, benefits very much from that consumption boost we talked about in the budget. And Aditya Vision is in the middle of India, the Hindi heartland. They're catching up economically. It's poorer than the rest of India. And they didn't have widespread availability of power all day previously. There's no point buying a brand new TV if you have no power to watch it. And that's changed over the last decade. They have a really strong competitive advantage because of their trustworthy nature, their brand, and their dominance of their markets. Again, C rating for ESG, 700 million market cap and out of index, but a pure play on the bits of India that we like. V-Mart on the right-hand side is a clothing retailer focusing on small town, rural India. So benefiting from the demographics, the stronger rural economy, and the shift to the organized sector. We've met them 21 times over the last decade. Again, out of index, about $1 billion market cap, a B for ESG, really plugged into the bits of India that where we see the fastest growth. And again, not in the ETF or the index. Finally, let's move on to financing India, which as you saw was a big part of the portfolio as well. Here we have both growth and value. And obviously value in India is something that sometimes causes a problem, as we talked about earlier on. So Mahindra Finance, it focuses on rural India. Again, mainly vehicle finance, benefiting from the growth surge we're seeing there, and is a beneficiary of lower interest rates, giving the funding mix that they have. They had 19% growth in net assets in the last quarter. There's no sign of a slowdown there, in contrary to the market fears currently. HDFC Bank in the middle. It's the largest bank in India. I've met them over 30 years. They have consistently excellent management, and valuations are a 20% discount to their 5-year average. There's real value there. As there is in IndusInd Bank, which is the 5th largest private sector bank, benefits from a rural focus as well as lower interest rates, and it's 50% cheaper than the big 2 private sector banks. So you have growth, banks that are well positioned for the environment that we see, as well as really good valuations here as well. So this is why we like this area. Moving on to the next slide. Well, given how we look at things, how have we done over the last decade? Well, we believe that our long-term perspective combined with our in-depth knowledge really delivers results. And that focus on new India, structural themes, the best of India, has led over 10 years on the right-hand side to be a top quartile return. 5 years the same, 2020, 2021, 2022, the early part of 23, consistently above our peers. At the back end of 2024, the 12-month period ending August, we did badly. That's because low-quality companies, in our view, particularly state-owned companies, did really well. Now, that's rare. It happens 30% of the time and never by this magnitude. In contrast, small cap, where we have a bias, outperforms 80% of the time. We stick to our process because we know it works consistently. We didn't chase things. We didn't lower our quality standards. That period then ended, and you saw at the back end of last year, again, we consistently beat our peer group. So it's a very strong track record. We stick to what we know works over the last decade. So then to conclude on the last slide, here at Alquity, we have a really experienced team, a lot of knowledge, and a long-term perspective. Our portfolio is really different from the ETF from our peers, domestically focused, focusing on the best of India. There's direct impact in our portfolio and also from the donation to the foundation. We have a fully integrated ESG process, which helps us minimize risks. And India is an uncorrelated stock pickers market, huge alpha potential, lots of secular growth trends, And that's why we like it so much. And it has a real deserves to very much be a standalone allocation in people's portfolios. So, Mark, please open the floor to Q&A.
Thanks, Mike. So you know the principle, you have the Q&A tab at the bottom of your screen, so you can write some question, and we have already some. The first one is, if India growth is driven by demography, not by export, how could it grow as fast as China did, and India always has a large population? What makes it different the next 10 years that this will be an outsized growth driver?
So, sure, exports will be the icing on the cake for India. Modi has focused on the Made in India plan. We're seeing some success of that, and India has a real competitive advantage in some places like auto parts, etc. Now, obviously, that's a little bit harder in the world we now live in with Trump and tariffs and so on. So what they're doing at the moment is, instead of importing things, they're encouraging companies to set up manufacturing in India. So that reduces the import bill and creates jobs and growth in India from domestic manufacturing, and they can export from that as well. India has a domestic captive market of 1.4 billion. So you have massive economies of scale like China has, and like the US has to a smaller extent, and the EU with a single market. So companies will want to manufacture in India and then use that as an export base. So that absolutely will drive growth and reduce imports. Will it grow as fast as China did in the early years? Probably not. I think there's some way to go, but it will be one of the, if not the fastest growing large economy for the next 10, 15, 20 years, driven by that shift, the demographics, the shift from the unorganized to the organized sector, etc. So we're in no doubt that we're in the very early foothills of growth, and we have a good decade or more ahead of us, probably a lot more. And the scare in the market that growth has come to an end is purely an illusory blip.
Thanks, Mike. To continue on the export, what do you think about the visit of Modi in the US to visit President Trump?
So they get on quite well, and although India does have high tariffs, and Trump has certainly called that out, what we have seen overnight, and it's obviously early indications, is India has agreed to purchase more oil and gas from America rather than Russia, also to import more weapons from the US. So I think we have to see how the relationship develops, as we do with Trump and all his trade partners. There will be comments and news flow every day, I'm sure, for an extended period. The certainly good news is that they didn't have a falling out, and Trump didn't particularly single them out in terms of putting lots of high tariffs on them immediately. Now, that could still happen, as it could, particularly, I think, with the EU and other markets such as Mexico and China. Now, so you're starting from a good place with the relationship. If that does happen, remember that exports to the US from India are a negligible part of GDP. It doesn't really matter. And in Trump's first term, there were some tariffs put on, impacting, I think, about 12% of Indian exports. And as we know, that had absolutely no impact on growth. So India is one of the most immune from Trump's policies because it's driven by domestics. It's not zero risk, but it's very low versus pretty much any other developed and emerging economy out there, as we've seen with the EU, with Canada already.
Thanks, Mike. Can you elaborate a bit on the rupee at the moment, the level of the rupee and the impact in the portfolio?
Sure. So we expect the rupee to be broadly stable. That's plus or minus 5% a year. And it's been a little bit weaker. That, again, has come from the same problem, which is concerns about growth. We've seen some foreign outflows from the market. Domestics carry on buying the market. There's been virtually no let up in that. But foreigners have taken some money out, which has led to some weakness in the rupee. When growth picks up, as we have seen, we can clearly see that happening. Then foreigners, I would imagine, would then start adding back to the market and the rupee will strengthen. So that's the very short term dynamics that we've seen. And it's a self-fulfilling prophecy. People see a weak rupee, they get worried, etc. So that cycle will be broken with growth being seen to pick up. Longer term, if we have an ending of wars in the Middle East and Ukraine, as Trump is talking about, then that's very bearish for the oil price. And that's really good for India. India's biggest single import bill is oil and gas. It's one of the most exposed globally. And so lower oil prices will be positive for the rupee longer term.
Thanks, Mike. Do you see AI turbocharging the structural growth in India, especially for the small cap bias in the portfolio?
I think it's too early to tell. I think AI has huge potential. India certainly wants to be very much part of the conversation. I think there's positives in how it could streamline the bureaucracy, which is happening anyway. And Modi obviously has unlocked India's potential in terms of demographics by reform that we saw in his first and second term. And that's why India really is a different story now to 5 years ago. So they want to harness the power of AI to do that more. I think it's far too early. When it comes to the software companies, which obviously India is a world-class beater at, there's positives as well as risks there. Could it remove the need for some computer programming? Very possibly. But again, it's too early to tell. So it's probably a positive for the economy as a whole, early, but there could be some risks on the IT side.
Thanks, Mike. How much have the mid caps corrected compared to the large? Are you more cautious on mid versus large? And obviously, to further extent, also with the small caps.
Yeah, so let's put mid and small in the same bucket. We've seen a 20+% correction versus the large, and some companies are down 30% or more from their peak. We think that's an opportunity. We think that as the growth picks up, and we see that with the GDP numbers, with further interest rate cuts, with inflation remaining under control, giving people more consuming power, see the impact of the budget feeds through. All these things point to an acceleration of growth, and that is very positive for the small and mid-cap companies. Will they bounce tomorrow? Will they bounce in 2 months? I cannot possibly tell you. Sentiment in India turns very, very quickly, and the advantage that we have is that we focus on great companies with great ESG, strong balance sheets, and that benefit from India's themes. So we take that institutional long-term approach and apply it to a retail-driven, sentiment-driven, volatile market. And you look through this noise. You take advantage of opportunities when they arise, and that's how you deliver the alpha. So on a 6 and 12-month view, and we're long-term investors, we're not traders, we absolutely are positive on the small and mid-cap. On a 1-week view, your guess is as good as mine, clearly, but we will take advantage of unjustified weakness to top up names that we like, as we have done, and we continue to do so as we continue to be getting inflows into our funds, which again, I think tells you something about sentiment and how that is going to turn.
Talking about sentiment, and it will be the last question, with the bad market sentiment at the moment, do you consider that is a good entry point for India?
Yes. No, that's an easy one. Absolutely. No, India is clearly a long-term, multi-year, multi-decade structural story. This is an attractive entry point for the long-term investor. You must have a 3 to 5 year horizon. Clearly, markets can go up and down. Things can go down next week. They can go up. We're not market timers. And so, we're not calling a bottom. But on a 3 to 5 year view, and actually on a shorter view, yes, I absolutely believe this is an opportunity, given the reasons for the sell-off are false, and we can see, and the data supports, that growth is already accelerating from that low. That's our analysis, and that's why we're positive going forward.